Imagine what it's going to be like when we have a downturn and there's an inability of central banks to respond to that. So that shift in Fed policy, which came at the end of the year, was necessitated by these weakening conditions around the world. I think the key is us staying on top of these changes that we're talking about and responding to them. First of all, I think every portfolio should have the right amount of diversification in it. Gold is an important portfolio diversifier. However, let me be clear, I don't think anyone should have a concentrated portfolio now, okay? So people can hone in on one comment I'm making. I think that the notion of creating a balanced portfolio is the most important thing that they can do right now, because wealth can't so much be destroyed as it can be shifted. And so the world right now largely looks, to me, leverage long. In other words, there's been a lot of borrowing to buy assets, to buy companies. Companies have borrowed money to buy their equities back and so on. That whole move of leverage long is where the market is. I think there's a vulnerability, what I'm saying is, to that kind of a portfolio, and that gold is one of the items that can diversify that. I believe it always should be a certain part of the portfolio because there's a certain environment that it diversifies the portfolio well and a certain environment to worry about. I also think that that environment is riskier, more likely recently now. And that environment is one in which it becomes very difficult to stimulate the economy, and there's a desire to depreciate the value of currencies. Now, so when one owns a bond or one owns a debt instrument, one is paid a pile of currency over a period of time. When there are a lot of obligations like that, a lot of debt, or even unfunded obligations like pension obligations or healthcare obligations that the world has, a lot of obligations, and there's not an effective monetary policy to lower interest rates and stimulate, as we're talking about, there needs to be the printing of money, that running larger deficits. We're going to come into an environment, I think, in which there are going to be larger deficits that are increasingly monetized. And in that kind of an environment, the currencies are depreciated. I think that in an evolutionary way, over the next 1, 2, and 3 years, that there will be a turn for the worse. Yes, I think that there'll be an environment in which you're going to have excess capacity and debt restructurings and political issues entering into it. I think there's going to be an effect, a risk. Well, of course, recessions are always inevitable. The only question is when. And I think that you're seeing this around the world. You could see it through Asia. You could see it in Europe, and you could see it in the United States. Let's step back maybe and put the big factors in perspective, I think, and then put a time horizon to that. I think the big factors are we are rather late in both the short-term debt cycles and the long-term debt cycles, meaning the capacity of central banks to produce stimulation. It can be measured by their ability to lower interest rates significantly and do quantitative easing and have that purchased. We have a problem there. Okay, that's a big thing, but it's not an immediate problem. It's a problem that is going to come in the next 1 or 2 years. You're seeing it in Europe, you see it in Japan, and to some extent you're seeing it in the United States. In addition, we have the wealth gap. And with that wealth gap, we have the classic political conflict, very much like the 1930s, in which that means that there's greater polarity, greater extremes in both of those. And that will play a role, because if you change policies, you will have a big effect. For example, when we cut the corporate taxes, that puts stocks up because after taxes you get more, so you pay more for your stocks. That'll change. So we have this polarity, very much like the 1930s, an inability to stimulate in the same way, and a polarity. In addition, we have China as an emerging country challenging the United States as an established country. And that creates a theme, that creates a protectionist type of environment, very much like the 1930s. And it also has implications in terms of all sorts of conflict and, frankly, sand in the gears of the efficiency of the economy. For example, the supply lines. In other words, we built an economy in which there was interdependency and efficiency coming from supply lines working in a certain way. Now, as we enter this environment of conflict, there needs to be, for personal security, for the security of the countries, there is a move toward independence. The United States says, I don't want your technologies. And China says, I can't depend on you giving me your technologies. And that changes, that separation changes the nature of the dynamic, which is also an economic influence. Those influences are very similar, as I say, to the late 1930s. They will be dominant. They are evolutionary influences, but they'll play out over the next 1, 2, 3 years, I think, in creating a paradigm shift. The world we're going to be in is a very different world than the world we were in. The world we were in started in 2008 and had to do with central banks printing money and stimulating, and that is reaching its limit. And that's why I think we're going to see a paradigm shift.
So what do you mean by a depression? Okay. Something like happened in the 1930s. So just to repeat, 1929 to 1932, there was a fall in the economy and a very double-digit unemployment rates and a magnitude of fall in the economy like about 10%. Do I think we're in that? Yes. How was that dealt with? 1933. What they did is they printed a lot of money. And the government came out with the same type of programs that we're having now. Yes, okay, same thing. Interest rates hit zero, same thing. Okay, same dynamics. And then that money causes an expansion from that point. How long does it take for the stock market to exceed its highs? Or how long does it take for the economy to exceed its former highs? A long time. Okay, do I think that's what we're in? Yes, that's what we're in. We've seen that happen repeatedly in history, many, many times. It's just the most recent one. And there's a structure to that. So yes, this is not a recession. This is a breakdown, an operation that I'm just describing in terms of how it's dealt with, the production of money and credit and all of that. That's what we're in. I think what you're going to see is a combination you're seeing of printing money and redistribution. And I think it'll last. These things happen pretty quickly. They last maybe a couple of 3 years in terms of that process. And then you have a rebuilding. And they're dealt with creativity. The greatest force through time is inventiveness, human inventiveness, adaptability. So you're going to see these restructurings happen. And it's the power of that adaptation. I did a study that goes back 500 years, and it shows real GDP. In other words, economic activity going back there. And there's a line. And you don't see these depressions, as we're calling them, even on that line. They barely wiggles. When you go into it and you look at that piece, that's what it looks like. GDP falls 10%, unemployment goes up, and it passes. And because the greatest force is the force of adaptation and inventiveness if we can operate well together. The world will be very different